Thank you for standing by. Welcome to the Carlyle Group Second Quarter 2023 Earnings Conference Call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question-and-answer session. To ask a question during the session, you'll need to press star 11 on your telephone. You will then hear an automated message advising your hand is raised. To remove yourself from the queue, please press star 11 again. Please be advised that today's conference is being recorded. I would now like to hand the conference over to Daniel Harris, Head of Investor Relations. Please go ahead, sir.
Thank you, Norma. Good morning and welcome to Carlyle's second quarter 2023 earnings call. With me on the call this morning is our Chief Executive Officer, Harvey Schwartz, Chief Financial Officer, Kurt Buser, and incoming Chief Financial Officer and Head of Corporate Strategy, John Redett. Earlier this morning, we issued a press release and a detailed earnings presentation, which is also available on our investor relations website. This call is being webcast and a replay will be available on our website. We will refer to certain non-GAAP financial measures during today's call. These measures should not be considered in isolation from or as a substitute for measures prepared in accordance with generally accepted accounting principles. We have provided reconciliation of these measures to GAAP in our earnings release to the extent reasonably available. Any forward-looking statements made today do not guarantee future performance, and undue reliance should not be placed on them. These statements are based on current management expectations and involve inherent risks and uncertainties, including those identified in the Risk Factors section of our annual report on Form 10-K that could cause actual results to differ materially from those indicated. Carlyle assumes no obligation to update any forward-looking statements at any time. So turning to our results, for the second quarter, we generated $207 million in fee-related earnings and $389 million in distributable earnings, with DE per common share of 88 cents. Our accrued carry balance was $3.7 billion as of the end of the quarter, and we declared a quarterly dividend of 35 cents per common share. In order to ensure participation by all those on the line today, please limit yourself to one question and then return to the queue for any additional follow-ups. And with that, let me turn the call over to our Chief Executive Officer, Harvey Schwartz.
Thanks, Dan. Good morning, everyone, and thank you for joining us. I'm excited to be joined today by John Redett, who you'll hear from later, as well as Kurt. There are two areas I'd like to cover. First, the macro environment, and second, a review of several work streams that will position us to drive long-term growth. First, the macro environment. As I've said previously, we're in one of the most complex periods in recent economic history. The combination of sustained elevated inflation, along with central bank rate hikes, has led to a corresponding increase in the cost of capital. The peak of the inflationary cycle may have passed, but our base case is that rates stay higher for longer as we shift away from a decade of zero interest rate policy. It remains early days in understanding the impact of this shift on corporate capital structures and liquidity. Among other factors, this shift in interest rates further contributes to mixed investor appetite and sentiment. In part, our economic and market views are informed by the vast data and proprietary insights gathered from our portfolio. The data set includes nearly 300 global companies, 600 real estate investments, and loans to over 1,300 issuers. Let's start with inflation. We're starting to see it's more difficult for our portfolio companies to pass through increased cost, reinforcing the view that the inflationary cycle has peaked. Our portfolio company CEOs remain generally cautious in terms of how they're approaching the operating environment, but broadly, our portfolios have seen accelerating activity with over 10% EBITDA growth. As you'd expect, these economic forces have slowed the pace of investment across the industry. You see this in the amount of capital we are deploying, and you see it in lower fundraising as LPs slow decision-making on new fund allocations. Having said that, in general, our teams are seeing signs of an increasing pace of early deal flow access across most asset classes. Now I want to update you on 5 key areas that we are focused on as a leadership team, though these are just a sample of activities around the firm. We have mobilized teams and launched work streams for each of these. As you'd expect, we are approaching these in a very deliberate and methodical manner, and while early, let me give you a line of sight into what we're doing. First, our insurance solutions business. Our relationship with Fortitude is profitable, strategic, and vital, but only one piece in the opportunity set. As insurance companies look to free up capital and shift liabilities to improve their ROE, We're seeing a greater interest on their part to partner with us in a variety of important ways. Second, our capital markets team. They also have a large opportunity to scale their impact. We have in place today all the key ingredients for growth: a well-positioned and active private equity franchise and an experienced capital markets team. As activity rates pick up, we expect that we will further leverage our deal flow and our portfolio companies' need for capital to create a natural tailwind in this business. Third, we're also focused on our technology and our AI strategy. This allows us to create operational efficiencies across the firm as well as at our portfolio companies, and is an important driver of growth and scale over the long term. We recently appointed Lucia Suarez as our new Chief Information Officer and Head of Technology Transformation. She will work closely with the entire leadership team to drive technology transformation strategy and operations. Now, fourth, as we said before, we see long-term opportunity around private wealth. We've recently hired a new head of private wealth strategy. While we only have 3 products in the market covering $5 billion of assets today, we view this as an important channel for growth. We'll be working with our distribution partners to bring product innovation globally to the wealth channel. Most importantly, the Carlyle brand is a huge differentiator here. And fifth, the last work stream I'll mention is around expense management and improving FRE margin. This means investing in our platform wisely to drive top-line growth, as well as closely monitoring the overall level and composition of expense, as well as the capital required to run the firm. This is a critical strategic effort. We will continue to move with a disciplined sense of urgency around each one of these, and we'll continue to update you as these progress. To close, as I said, we're still operating within a somewhat challenging market backdrop. It's important to state that we will be patient when we need to be, while at the same time capitalizing on opportunities to deploy capital where we see attractive risk-reward. As a leadership team, we are intensely focused on delivering performance excellence for our investors and driving long-term shareholder value. We are taking action to mobilize teams around priority areas to drive disciplined growth, and I'm really enthusiastic for Carlyle's future. Now, before I hand it to John, I'd also like to take a moment to thank Kurt for his tremendous contributions to Carlyle over the last nearly 20 years. I personally am thankful for Kurt's counsel and support as I transitioned into Carlyle over the past 6 months, and I've really enjoyed getting to know him. I know you'll all join me in wishing him the best in his upcoming retirement. And now, John, over to you.
Thanks, Harvey. Good morning, everyone. I also want to thank Kurt for his 20 years of leadership at Carlyle and for the guidance he continues to provide me as I transition into the CFO role. I look forward to working more closely with many of you in the coming periods. As Harvey highlighted, we delivered solid results this quarter in a tough environment, driven by a diversified investment platform and the focus of our global investment teams. We produced $389 million in distributable earnings for the second quarter, or 88 cents in DE per share. Year to date, we have generated $660 million of DE, or $1.51 in DE per share. We repurchased 60 million of shares in the second quarter and have repurchased 160 million in the first half of the year. Today, I'm going to focus my remarks on 3 main areas: fee-related earnings in the near-term outlook, accrued carry, and fundraising. First, fee-related earnings. FRE increased to $207 million in the quarter, up from $193 million in Q1 2023. Relative to the second quarter last year, FRE declined 12% as modest growth in revenue was offset by continued investment into our people and teams. Year to date, FRE of $401 million was down 5% compared to the same period last year. Second quarter management fees of $515 million increased sequentially after having declined for a few quarters, with increases in each of our segments. Over the next few quarters, new fund launches and fee activations should support continued management fee growth. Our second quarter results benefited from $73 million in fee-related performance revenue. Looking ahead, we are not expecting to generate material fee-related performance revenue in global private equity in the second half of 2023, though global credit fee-related performance revenue should remain stable. Transaction and advisory fees were $18 million in the quarter, down significantly from a year ago given muted capital markets activity, which has pressured both FRE and the margins. And as you heard from Harvey, driving an increasing level of transaction revenue from our investment platforms is a major focus area for the firm. Compensation expense was $289 million in the second quarter, an 11% increase year over year. A majority of the increase this quarter was a function of higher fee-related performance revenue, as we generally accrue compensation at 45% of associated revenue. Excluding this impact, compensation expense increased only 5% year over year. G&A expense of $102 million reflects a more normalized set of firm-wide activities relative to lower levels we saw during the pandemic. This quarter also included external fundraising costs largely captured in global investment solutions, which supported fundraising momentum. G&A expense may tick up in the back half of the year as we typically have increased operating costs tied to our LP conferences. With regards to our FRE outlook, second half 2023 FRE is likely to be similar in the aggregate to the first half of 2023, with a relatively stronger fourth quarter. We remain focused on generating sustainable top-line revenue growth as well as diversifying and growing FRE. Moving on, I'd like to discuss our net accrued carry. Our global carry fund portfolio appreciated 2% in the quarter, with relative strength in infrastructure and natural resources, owing to an uptick in announced transactions. We had more muted appreciation in private equity and real estate. Our net accrued carry balance of $3.7 billion declined from $4 billion last quarter. Most of this decline was driven by $175 million in net realizations, with the balance due to a reduction in accrued carry in global private equity. Even with this decline, the net accrual remains at a robust $10 per share, which is a substantial source of future shareholder value. Let me finish up with an update on fundraising. Fund investors continue to face challenging decisions and make commitments more slowly than in previous years. Despite this slowdown, we still expect to raise a larger amount of capital in 2023 than we did in 2022. Through the first half of 2023, we raised $14 billion of new capital, approximately halfway to last year's fundraising total. We have momentum in several important strategies that should see inflows in the second half of 2023, likely weighted towards the fourth quarter. In global investment solutions, we are off to a good start for our latest vintage secondaries and co-investment strategies, which should both continue into the second half of the year and into 2024. This new capital will turn on management fees later this year. In global credit, we expect to grow off a slower start to 2023. We've priced 2 CLOs in the second quarter after none in the first quarter. Our Credit Opportunities Fund should continue to attract more capital, and a number of strategies and SMAs are positioned to generate positive flows, with the fourth quarter likely to be relatively stronger than the third quarter. In global private equity, we expect to raise capital in the second half of the year in several buyout funds and various real asset strategies. Wrapping up, let me reiterate my excitement to be in this new role, working alongside Harvey and the entire Carlyle team to drive shareholder value. We are excited about the opportunities for continued growth and improved operational performance. With that, let me turn the call over to the operator for your questions.
Thank you. As a reminder to ask